Thank you so much for coming to check out another episode of the Stashcast, where we have interesting conversations with interesting people focused around the world of commercial real estate and prop tech. The Stashcast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions? You can with Needle. Come check it out at Needle, NEDL.US to learn more. All right, today I've got my friend William Knapp, head of investments at GoldOller Real Estate, and I'm excited to talk to you today, William. Thanks for coming.
Excited to be here. Thanks for having me.
Yeah. So you and I have been talking for probably 10 years now. Meet up at NMHC, have gotten close on a couple of things, but haven't yet tied the knot, so to speak, on anything. But so I know this is all to say, I know who you are. But for the folks at home who don't, why don't you tell us who you are and what you do?
Yeah, sure. No, it's been great. I guess flirting is the term I use for the
Yeah.
last 10 years. It only takes one for it to, it's been fun along the way.
Yeah.
Yeah. So I've been at Gold Dollar now 11 years. We are a multifamily owner operator, broadly speaking, eastern half of the U.S., Midwest, Southeast, Mid-Atlantic. We have about 20,000 units under management broadly in the sort of B class suburban and value add garden apartment space with variants on that theme. We have some older, some newer, some construction, some more opportunistic and so on. And in particular, in sort of your market, what we've been talking, like we've actually grown a pretty big footprint in Ohio too. So 6 or 7. So been lucrative. Yeah. Been a good area for us. The times are interesting now and trying to make our way.
Yeah. Yeah, they definitely are. So when I think about GoldOller, the thing that I think is big deals. Like that was one of the first things you said to me. Like, we want massive deals, deals bigger than anybody else can handle. And so I guess where did that want or desire for those deals like that to come from? Or where did that drive for acquiring properties like that come from? And then how are you able to do those when others falter? Because you guys were recently appointed receiver of how many units is that? 900 units here in town?
Yeah, 970 or something like that.
Yeah, that's a small city.
And that would actually be your point, I think, fourth or fifth largest. Yeah, it wasn't so much a strategy to start looking at the bigger ones. Part of the impetus or the desire or the ability stems from the fact that we're a property management company. That's effectively core value we bring. If you were investing in multifamily deals looking for higher yields 10 years ago, a big opportunity there was on the bigger assets and maybe what then had been sleepier markets. So Indianapolis's and Jacksonville's and the like. And so if you're not doing the more aggressive turnarounds or value add financing strategies, or typical in the later teens and in the COVID era, buying at scale, getting efficiencies in your operations, efficiencies in your business planning too. A 2,000 unit property only really needs one monument sign or one clubhouse to put it real estate. Your dollars can go a little further. And we had success through our investment partners buying some of these large assets. And I almost want to say it's a niche. Again, it's not a specific strategy. 5 properties over units and they've done pretty well in all of it. So
Yeah.
it's
I, you might be able to consider it a niche because I think as what I hear every day is I want 250 units, 80s, 90s, even 2000s vintage, because that's our sweet spot, maybe 300. And seems like you guys have figured out how to handle those larger things. So,
yeah, operationally and on an investment perspective, for sure. The funny thing to your point is that the most aggressive or most engaged, I'd say, investor groups over the last couple of years have been the smaller check writers. So we have been spending a little more time on those, even under 200 units, which is the other side of having the management platforms. If we're operating in a market, we can more easily pick up the smaller ones because it's an addition to our platform.
yeah, you can just fold that in with everything else. How did you get into real estate? What were you doing before you joined GoldOller?
I was at a real estate services firm in Philadelphia, consulting like owner's rep, development management. We would develop facilities for universities and hospitals and other groups like that. I actually spent a little bit of time working on the Sixers practice facility that was built in Camden about 8 years ago. Outside Philadelphia. Was in real estate for that. Honestly, as I like to say, I got SimCity, the video game, when I was 5 years
Yeah.
old, and was just like interested in that stuff in general my whole life. So it's just an obvious path. Went to school for city planning. Actually, real estate was an obvious thing to do with that. So here I am.
Did you play SimCity 2000?
I started on the original one, but yeah,
Yeah.
2000 is when it got serious.
I figured out what the cheat codes were, and I would just give myself unlimited money.
Yeah, then you get bored and you burn it all down.
Yes.
Just kind of,
It's funny. That's the second time I think SimCity's come up in the podcast so
yeah,
far.
cool. Wait, we should start a club.
I've tried to find it just to have it and play it again. I can't find it anywhere. So
It's fine. Yeah.
separate note.
On
Um,
to something.
yeah, exactly. So you were on the developer rep side or the owner's rep doing development, studied city planning, and then you just answered a job posting it for GoldOller or
Effectively, yeah. My prior firm, this was the aftermath of the global financial crisis. Everyone was sitting on the sidelines. We had the sort of management and development expertise to do projects that we were fundamentally earning fees, right? We weren't putting money at risk. And I'd been tasked with trying to find some smaller, like adaptive reuse type deals, do on our own account. And there were opportunities. We found some investors, pieces, but it just seemed like there wasn't quite the aggression maybe in like pulling the trigger and going. And so I was always looking to the next thing. And frankly, it was just a listing. The GoldOller was originally a single source investor with a Middle Eastern partner that we bought our first 7,000 units with. And I started right as they pulled back and decided they weren't investing in multifamily anymore. Cause as we know, 2013 was obviously the top of the market. So it was just at a period of transition. We diversified, stepped in, and it's been a good run.
Mhm. So how have you and maybe this is others in the firm, but maybe as the firm, how have you gone and courted other capital sources?
A lot of it comes from reputation, frankly. I mentioned it was a Middle Eastern group that we started with. We continue to have other partners there, and there's like a word, honestly, that comes from it. Beyond that, really, we're not a fund. We have separate limited part, but that ranges from family offices to real estate PE firms all the way to more institutional players. And again, it's a case where having a management company is a good entree because we're not just a couple guys that can do financial models. It's an actual company with hundreds of employees, right?
Yeah.
Uh, and nice looking websites, swag and materials and all that stuff. So there's just a lot of ways we work on that. Consistent track record of closing on deals. A lot of the good recommendations from people like yourself. You make recommendations to me as well. Living it together.
Yeah. So when somebody's coming to you guys, they're looking for, I guess the service you're selling is investing in real estate. It's a solid, reliable asset. You're investing with a known quantity as far as a company and reputation. Are you doing, I don't, you and I haven't looked at any ground up development. Is it mostly just the value add existing asset space? Or are you looking at ground ups too?
And 95% is value add broadly. And that could be the 70s built, 80% occupancy. That's a real management turnaround all the way up to 2015. And you're just like painting it and enhancing the units a little bit.
Yeah.
We do have a development affiliate based in New York it does a couple multifamily deals that we then end up managing. We've done some self-storage actually in Philadelphia where we're based. Just an opportunity that we jumped on around the area of the pandemic. Those have gone well, but whether we're going to, scale that up or not is to be determined. But there's been like other stuff, but the company that you would come across is a multifamily management firm. And that's what our bread and butter is.
Talked about it a little bit at the top. Like what are your thoughts on the market today? Because we're sitting here mid-August. I keep seeing whispers of an emergency rate cut coming, things like that. What are your thoughts? What do you feel?
Yeah, it's interesting. Obviously, it's been very slow. Really, I think 24 has been the slowest for us, even more than last year. In 22, people were still adjusting to the higher interest rate environment and transaction were still getting done because people needed to. Rates are down, probably go down further. Values have adjusted, but if people think they haven't adjusted enough. And even some of the operational slowdown, I don't think is that worrisome. And things are just back to normal in a way. Was having 10% economic vacancy and 2% top line rent growth, you know, a disaster relative to what we thought in 2019 or 2021, sure. But it also is like much more in line. That's 15 years of it.
Yeah.
And I think for the more established people who've been in the market and tracking it, you really can see that the deals make sense in a lot of cases. Like the underwriting makes sense, the values make sense. Are you thinking everything is a steal and it's the best opportunity? No, of course not. But the rate at which we are finding interesting things to spend our time on really isn't any different than it's been for the whole time I've been at this. So
That's
I'm
good.
optimistic.
Yeah.
I have to.
Yeah, so do I. Yeah, I've heard that let's stay alive until 25.
Yeah.
And and even the back half of this year looks much more robust than certainly the first half of this year was.
I think it's really interesting. And I've started noticing this very recently is that let's say up to 2019, everyone talked about cap rate compression. I think what was more interesting was the cap rate convergence that across sort of regions or asset qualities, like everything moved to the same level. So like maybe you'd pay a better cap rate for newer, nicer deal. You also pay a lower one because you thought there was upside.
Yeah,
What I'm seeing now is that in some of the more sleepier markets, let's say, or some of the older asset types, there is actually a cap premium. So like you can buy the traditional workforce type stuff without having to bet that you're going to raise rents 30% 3 years.
just
Uh,
to make the deal work.
Exactly. Like it's just, you're going to buy this, big old thing and it's going to be a beast to manage, but you're going to be getting the coupon like over time. And at least from an underwriting perspective, that seems to be back now. Things feel a lot more like they did, I don't know, 10 years ago than they did 5 years ago. I'm okay with
Yeah. Yeah, we did see a big run up and it was for a while. It's, okay, yeah, we'll show a 15% increase in our year 1 pro forma, and it was what you had to do to get the deal, but also how it would actually trade, if not even higher than that. And it's crazy, but that's the way the market was.
Yeah, there's a lot of the pushback, and it makes sense too. I'm not saying people see positive leverage point. You're having to justify how you get to some promised land by the second or third year. And the pressure that like the hoop you had to jump through isn't quite there anymore. It's more valuing things for all the reasons you wanted to before.
Yeah. When you guys are executing on a value add, have you found things that are uh, the best drivers of, is it ceiling fans? Is it kitchens? What have you found there?
I joke that my job can be boiled down to finding places to add plank flooring and laundry sets. So those are probably the two items I just return. It's no brainers. So we add them pretty much wherever we can. A lot of what people don't think about, I think, are just like ancillary income drivers as well. Like laundry sets, cable and internet packages, the things that people like me can eye roll out fenced in yards and things like that are always in the broker books, but they actually make a lot of sense and add a lot of value beyond just saying you're going to add the new quartz counters or whatever. One thing that has happened with the decline in fundamentals is I think the like return on investment of like kitchen renovations overall has gone down. Just that it's harder to show like the spread basically in rents. So what maybe was 25 or 30% return on investment is probably more 15 or 20. And that's just based on rents not growing at the rates they used to be and just returning to.
Yeah. Do you think that rents are topped out?
In an extent, they're not doing what they were and you have to work for it. I think they'll keep growing. We don't build enough housing in this country, right? So there's like fundamentally an upward pressure on rents in most markets, but you have to justify it in more cases. Like the idea that you can buy an 80s property and enjoy the excellent top line rent growth or just do cosmetic things. It's a risky strategy. You're not getting any younger. And at some level, you'd have to invest in it just to maintain your relative position in the market, especially with some of the
Yeah.
slowing. Yeah.
Yeah, even the things that you mentioned, plank floorings and putting washer dryer hookups in, that is what you do to keep a property like relevant and keep it active in the market because that is what the market has driven, it seems, over the past couple of and you want to put new flooring in anyway. So you might as well put something in that's going to last for a while instead of cheap linoleum that might last one turn.
Right. Then effectively, when you get past all the specifics of each property and the opportunity you think you see, overall, you're investing in a commodity product of which there are millions and millions of units. So it's a bet on the market as a whole. And if investing into it is just the best practice, then that's, really what it is. So like the upgraded kitchens aren't some sort of special sauce. It's just what goes hand in hand investing in multifamily. It's the same thing. You have to.
Have you guys implement with so many units? I would imagine that you've had some technology. You're not doing it all on QuickBooks or anything like that. So what sort of technologies have you implemented across the business and the platform to help make your job easier?
It's funny. I now get to point out that I'm not really on the operational side and they would rattle a million different services we use. A lot of it has been on sort of the marketing and leasing, the like targeting of that has gotten much better. Like follow-ups with leasing prospects. That seems to be the one that's having the most difference on the ground. We talk about how our leasing people are spending less time on just the kind of day-to-day touring and more time following up and trying to close on leases. Obviously, the pricing software is in the news these days. That's something we're all dealing with. We'll see what will happen there. But even recently, just like the pace at which new tech services are coming out is really pretty stunning. I was looking at it, I can't remember the name of it, but a company that basically you just take a picture of a unit and it will automatically code in whatever those finished levels are. We've had unit inspection software for years, but the idea that you're going to have a single way of coding that isn't specific to the quirks of your guy who's walking the units, like that means a lot, right? And standardizing. There's a lot out there.
I was talking to a company, they're a debt collector. And what they do is they look at the MLS photos and that are out there publicly available. And then they score every single room. And then they use that as a determination to figure out to the extent that they're going to go after and how hard they're going to go after that debt collection. I was
Oh,
like, that's amazing. And then I thought about it in a similar way to what you said. We went a couple of rounds on it and I lost steam with it with everything else I have going on. But I was like, what if you could use that same thing to say, okay, you could take a property's leasing website and you can see what the finishes look like and then say, okay, why don't we score it and then figure out what the best ways to do renovations on that then equal this much in premium that you might be able to add.
right.
So it's still in my list of things to do, but
Yeah. And those are the most interesting. We're talking about like investing, what interest rates and returns should be. But it's very much a business, right? Like you're operating something that requires people cleaning up and maintenance and everything you need to do each day. And the more you can take those more abstract, like analytical points out of the hands of like the site staff, you can let them focus more on just like the day-to-day customer service, right? Like they're spending less time thinking of a spreadsheet of what they should be, what the finished level of the unit should be, and more time dealing with the concerns of some tenant as an issue.
Mhm.
That's probably better value for everyone involved.
Yeah. So since you joined the firm, and you've brought on different capital partners, have you seen your and maybe this is a two-part question, but have you seen your criteria evolve in the types of deals that you're looking at? And then maybe the second part is, it feels like to me that, and I think you mentioned it, like when kind of we both got it, I started in brokerage in 2008, but I came here to Cincinnati in 2011 and started brokerage here then. And it felt like there were a couple of like known players at that time. But it seems like over the past couple of years, from probably, I want to say 16 onwards, feels like everybody and their brother has become a syndicator. Has that changed how you guys operate and how you try and differentiate yourself?
Yeah, I guess the evolution has gone hand in hand with like our development and with the other partners or source. Back to what was going on in around 2013 when I started, you were still buying on the idea just that multifamily values were good. The needle pointed up, fundamentals were going to be good. So maybe you were going to an Indianapolis, which wasn't really an institutional market at the time, but you just believe that the cap rates there and that the fundamentals that you were in really well. As we grew, we also had more expertise to be able to take on more aggressive sort of projects. So in 2016, for example, we did a deal in Philadelphia where we put 50 a unit on average into each one. That was basically a construction project.
Yeah.
And the returns made sense, but also like we were able to do it just because of scale to have that expertise in house. And then so that means you can then source people that want more aggressive type returns and so on. So like the evolution of the market was towards deeper value added returns. And that just mirrored our with the syndicators. The last couple of years have been really interesting, right? I remember like 21 and early 22, just like feeling like I didn't know what I was doing. "Oh, okay, here's where I think this price works. Like, yeah, I know mills are here. We're trying to underwrite to the market. And then someone else is millions of dollars. And then it doesn't help our bottom line, but you hear about some of these people handing the keys back now. And at some level, there's a return to normalcy. But fundamentally, people that are going to be more aggressive, doing edge have an advantage just in the transaction side. Obviously, so as much as you always call me up and say, "Hey, we'd like to work with you because we, think you're a reputable buyer," and it's like the same reason we're also not at the top of the offer price. So we're still navigating.
Yeah. Yeah. It's definitely a challenge. You, in my market in particular, you don't see a lot of that, a lot of those shenanigans that have happened with a few exceptions. There's always exceptions, but yeah, it was floating rate debt that got people in trouble, overpaying for deals. There's one over across the river where they bought like a 60s vintage deal and it's in the middle of a lot of happenings. And I think that they benchmarked it. They must have benchmarked it against, oh, here's a new 5-year-old deal that's getting 250 a foot. Of course, if we put in renovations, we're going to be able to get that. And I think they're really struggling with that one.
Yeah, there was, a lot of the, you know, 28, 21, 22, where you'd see something that had or necessitated sort of an aggressive plan. Yeah, maybe it made sense. You look at the way to finance it. And the problem was if everything went like more or less according to plan, you did okay. But the sort of like downside on that of anything else missing, interest rates, fundamentals, whatever it is, like all pointed like seriously negative. And that's been, especially when we've seen things a couple of years later for sale. Okay, where I thought it would be, but the value is like nowhere near what like we might have projected. Interesting.
Yeah. You're talking earlier about prices and the spread between expectations, at least from your chair, narrowing. I mean, last year we saw about a 20% spread on average between buyer and seller expectations. What have you seen? Are you like on deals that you're looking at? Are they telling you, "Hey, we want, I don't know, 50 million for it," and you're like, "We're at 40." We had one. They're like, "We want 62, 65," and we're like, "We can't even get to 50." I don't know how you see that.
There's some of them that are more driven by either like a loan balance problem or just the fact that the seller really isn't motivated. And those are tough to deal with. I mean, certainly on your side, but on our side too, that the value might not be real, but there's also a reason why they're sticking to their guns. So like a case, for example, where they're technically over levered underwater, like white fire sale, especially if the property's operating fine. Every year or the last couple of years, get together at MHC and talk about everything's turning around. It's going to be like back to normal. And one of the things that, outside of whatever interest rates are going to do or whatever maturities do, there's just an idea that like the vocation of it, like people are trying to earn a living, right? And like, how many times do you miss out on something or you just, I got to lean into this a little more. And I don't just mean us as like a sponsor, general partner, but more importantly, the investors, limited partners. They have all these great reasons to say why they won't look at X growth rates or cap rates need to be Y markets and so on. But if the market's telling you otherwise after a long time, you just start to play on the margin. I think that's definitely happened. That's what's been encouraging. Is I'm just getting like calls back a lot more. Not to say we've been like buying things, serious conversation at least.
What are the things that you look at when you're evaluating either an existing market that you're already in or a new market when you're exploring expanding your footprint, so to speak?
And the existing ones, it's funny because a lot of it relies on your firsthand experience, like what you can prove as far as your operations. Here are my expense levels. Here's what collections are like. We're experiencing this market. We're not, just having been get a keen sense for what is better or worse based on your sort of firsthand knowledge. I think in the new ones, it's been tougher to push that hard. The last couple of years, we're trying to lead on experience more. A lot of the sort of investor feedback is more on obviously demographics, school quality, things like that. And so we've mirrored that feedback as well. But on the other hand, that sort of like cap premium or spread on some more of the workforce type stuff is what entices us to look, right? Are we going to find an interesting return profile in Cedar Rapids or upstate New York or something just because the market is there, right? So those two sort of work against each other. Right? The things that sound like good headlines about demographics and school quality are not the same things that also say, oh, this is a damn near a 7 cap. So a little, it keeps you disciplined. Like I'd love to have the school quality and the 7 cap if I can, but usually you don't find it.
You see a lot of deals, I assume mostly through brokers or not?
Yeah, mostly. I don't know what the numbers are. We usually record sort of the source we get them from. The last 2, 3 years, the so-called like off-market ones are a much bigger percentage of what's available. And usually that's what everyone wants. More recently, it's for the wrong reason. You were saying with they want 62 and you're not even at 50. We see the 62 million ones for people with like Hotmail accounts. Like, I have a rent roll from 6 months ago. You want to buy this?
Yeah.
And some are direct or repeat business. Just you get more of the so-called like narrow marketed ones. That's a good reason you want this. Maybe it's ambitious pricing or this error on it, but you might be reaching out to 5 people instead of a broad blast. So technically marketed, more specifically targeted.
Yeah.
And those are good ones. We pretty much always
Nice.
never direct chat contacts. We do third party management as well. So there's cross sales process and if something does or doesn't make sense for either just the match or the investment side. Got to manage that.
So from your seat, what are the things that good brokers do really well and what are the things that you want to avoid?
Honestly, like the reaching out and giving the story helps a lot. We probably underwrite 3 or 400 a year. And obviously having all the supporting info and the OMs and all that stuff is great. But sometimes it's just like getting on the phone with someone and getting a little more of the candor is just like tough. You're making a million phone calls, but when you can connect and get that actual story, it helps you go, oh, okay, that's why I need to say that the big write-offs over the last year are going to get a little better, right? Might not just to put that on paper, but when talk through it, it makes sense. That's really helpful. I think the prior point too, and I get this sort of both ways is do you want to try to push people to get to where there is a sale and more aggressive pricing, or do you entice people easier? I don't really know the answer to that, but we've had more times recently put something and then get the call back couple of weeks late. Oh, no, it's not going to hit that price. We're down here now. So I haven't done the work. And it's especially tough for a group like us that is doing joint ventures. Like we don't have like our own sort of fund or something. So like the short timing sometimes is difficult.
Is that something that you see broker? So I've always, when I take a listing, I feel like it's my job, and it is my job to go out and get the seller the best price and terms. But I feel like I don't have any supporting evidence, but I feel like sometimes other brokers will almost like underprice their guidance initially in
Mhm.
order to create like a feeding frenzy and then push it up through best and final.
Yeah,
Do you see that? Is that a thing or am I just making it up?
it is. And I don't, the, of course, your goal is to, as you get the best price, right? And similarly, we're trying to justify the highest price we can. It's likely buyer. And to your point about not having the data, I don't know which is more effective. Do you aim high so people like stretch a little bit, or do you aim low and then they're engaged? I see it both ways. I deal with it on both sides. I think depends on just to guess like what market you're in or what the conditions are. So might make more sense if something's a demonstrably hot market. Does it just make more sense to be aggressive? I guess I've
Yeah.
probably seen that more.
Yeah.
So
You probably weed out more tire kickers that way.
yeah,
I just, I've thought to myself, how would you even have that conversation? Hey, William, we're great. I'm thrilled that you're going to list this with us. I know we told you this price, but we're actually going to go out 10% lower than that. And then we'll just push it up in best and final. I promise you, it's going to be fine.
yeah.
I feel like I'm pretty good at what we do, but I don't know. Feels like a risk.
We've sometimes had brokers talk that way in general, that not a surprise or just, hey, maybe it makes a little more sense, like not to reach or would it be aggressive? Yeah, depending on what you have. So there's definitely art to it.
Yeah, that's interesting. If somebody's interested in getting in touch with you and finding, or they've got 1,000 unit deal that is in a
Mhm.
great school district at a 7 or 8 cap, what's
Yeah.
the best way to get in touch with you?
Sure. Yeah. I think my info is on the website, but they can email directly, WNAP at GoldOller, GoldOller. And yeah. And we're definitely trying to be acquisitive. Obviously, you know that all the time is talking to you, but we have been, as I mentioned or to earlier, expanding our third party managed platform as well. As I think that does provide a lot of value in more uncertain times. So I can source those as well. If property you bought in 21 isn't performing to your expectations and you need a manager, what's up?
Yeah, I read through that book that you guys gave us. I was like, wow, this is awesome. This is amazing.
Yeah,
So,
it's like we're a serious outfit.
yeah, exactly. All right, William, thank you so much, my friend, and I hope you have a great rest of your day.
Yeah, this is great. Thanks for having me on. Really appreciate it.
You're welcome. All right,
Talk to you.
bye.
Bye.